Oh, baby. Just in. Whoa, Walt Disney earnings. We've been excited for Disney earnings for a while. There's always been, as I mentioned, one thing we're keeping an eye on when we're talking about Disney earnings. It's going to be Disney Plus, baby. That is what this company is right now. And frankly, as a result, this is what's going to make the stock price go up or down. You see after hours, already up 2%. And again, these earnings just popped in. So we're just now looking at the data for the first time. I haven't even peeked for you. No peeking. Okay? If you look over the last year with this stock, one thing I will say, the stock's up 35%. Personally, I believe the stock deserves to be up, maybe a slight bit more. No, it's aggressive of me. It's a little aggressive of me. But again, the stock's seen some positivity this whole year, even though it's been one that's been impacted quite a bit. Understand their core business in the park segment, which was their main business segment. I mentioned that for a reason, has now been overtaken by the streaming segment. So, but still, overall revenue has been down year over year. So let's take a look at these earnings, see what's making the stock pop so far. Sorry, that just gets me excited, baby. Non-GAAP EPS of 32 cents is a beat by 66 cents, and a GAAP EPS of 2 cents is a beat by 73. This is what I would call incredible. You're going to tell me there was no chance I thought this company was going to report profitability. Excuse me? How? I really don't even understand how it's possible that they remained profitable during this. That is what I consider wild. We'll have to look at the finer details and see what's going on there, but that's crazy stuff. Revenue of $16.25 billion, down 21% or 22% year over year. Not a shocker. It is a beat by $370 million. So again, they're picking up a lot of that money in the streaming segment as we go here. And okay, one thing I have to tell you, I was wrong. I told you I think this quarter we'd be sitting at 90 or 100 million. I gave a bold estimate, and I was unfortunately wrong. But it's a smasher. 94.9 million subscribers versus a 90.7 million consensus. 4 million subscribers over that consensus. Are you kidding me? Probably by the time right now, I assume that they are sitting at 100 million, or probably pretty darn close. So next quarter, they'll certainly report 100 million, but still, that's crazy good numbers there. Crazy good. Especially for a service that's been out literally a year. ESPN Plus subscribers. That number's only going to keep climbing, by the way, because of all the exclusives that they've announced. But just keep an eye on that. ESPN Plus subscribers at 12.1 versus 11.5. That's still crazy to me as ESPN Plus. I mean, sports have been hampered quite a bit, yet ESPN Plus has still been performing really well for them. So, really good stuff. Let's take a look at this press release. We love talking about press releases, okay? It's what we love to see. So overall, revenues we saw, nothing crazy. 22% decline year over year. Now, what's wild here, if you look at this net income line, down 99%. But what I wanted to mention here is it is actually positive. That's what I think is pretty impressive, that they still managed to post a positive number on this EPS line, which they haven't for the last 3 quarters. So I'll still take that as a win personally, because it is a major beat, honestly. So there's some positivity here. There is, but there's a lot of negatives here. It's not a shocker you see a lot of these negative in terms of changes, but it's something that is to be expected. For sure, as we look at segment results, obviously, pretty cool here. They mention, obviously, parks being shut down. So the most significant impact, obviously, was approximately $2.6 billion at the parks and experience segment. Yikes, of revenue loss. That's crazy, but completely expected. We see, if you're looking specifically for segment in terms of revenues, Disney Media and Entertainment Distributions saw a 5% decline, and Disney Parks, Experiences, and Products saw a 53% decline. Yikes. That's really what, you might expect there. So, you hate to see that. Yikes. So, but what we do care about here, if we look in specifically into these segments as a whole, you see the difference. So, as far as linear networks, obviously Fox is going to be one of the main things there. Saw a 2% increase actually, nothing significant, and you won't see anything significant from Fox. Direct to consumer, though, this is a segment you really want to look at. $3.5 billion compared to $2 billion of the year prior. That's a 73% increase in terms of that number there. Pretty impressive there. Content sales, licensing, and other actually declined 56% though, and eliminations saw a 37% decline as well, which is not positive, obviously. Operating income, no shocker. This direct-to-consumer line is actually really impressive for me. So, obviously, it's not profitable. Your linear network saw a little bit of a decline in profitability, but it really helped carry this company to profitability. But the direct-to-consumer line, you see last year they lost $1.1 billion on the quarter end because of this segment. Now, it shrank to $466 million. They shrank that by over half, which by these estimations, they'll probably be profitable by next quarter, potentially. I think they will. It'll be close, but I think they will. But what I find really crazy about that is they increased revenue by 73%, yet declined that operating loss by over 50%. So that's pretty impressive to me in that aspect, because that's a company that's pretty strong in terms of this. If they did not do this, obviously they wouldn't hit profitability goals. So pretty big to see what they did there. Really, really nice stuff. As far as linear networks, nothing super crazy. Domestic channels saw a little increase. International channels saw a little increase as well. Nothing super crazy with those. Obviously, the Fox networks. The major thing here, personally, is going to be this direct-to-consumer segment. I think that's what all of us investors want to look at. Obviously, they are mentioning the decrease in operating loss was due to the improved results at Hulu, and to a lesser extent at Disney Plus and ESPN Plus. Obviously, they're saying Hulu was the main source due to there. The increase at Hulu was due to subscriber growth and increased advertising revenues driven by higher impressions, partially offset by an increase in programming and production costs due to higher subscriber-based fees for programming the live television service, which is why they increased the price of Hulu Live. The improvement in Disney Plus was driven by subscribers, obviously, as we saw. Higher programming production cost, not a shocker there either. And ESPN Plus was driven by, what a shocker, subscriber growth. So let's look at the breakdown of subscribers. This is some quality stuff. Disney Plus, obviously, you see this is the very first quarter end results was where it's at 26.5 million, which is also incredibly impressive. But obviously the increase, it's incredible. I mean, it is an incredible increase. We're talking about 4 times the value here, nearly 3.5 times the subscribers in a matter of a year. Really impressive stuff there. See a 300% growth there, pretty nice. ESPN Plus even saw an 83% growth if you're talking about year over year. That's really impressive. And again, this is the biggest segment of their business right now. Hulu, as far as the VOD only, streaming VODs saw a 30% increase, and Live even saw a 25% increase. And I've mentioned this before, I think Hulu Live is going to be taking over more in terms of some of these cable services. Those who still have cable might want to switch to Hulu Live because it's probably one of the better options out there. As far as that's concerned, that's why you see a 25% increase year over year. And obviously I mentioned streaming, but total Hulu saw a 30% increase, as we saw. I mentioned the importance of streaming here, and just to put it into perspective, obviously this direct-to-consumer segment, really this whole media segment coming into $12.6 billion. When you look at just the media, right now the park segment came in at $3.5 billion. So the direct-to-consumer did as much as the Disney Parks and Experience products all combined did this year. So that's what I'm talking about. The segment that is taking over is that. That's the segment taking over, baby. Pretty exciting. Pretty exciting stuff. So content sales obviously saw an increase in terms of that. Disney Parks and Experiences, there's nothing super exciting to mention here because of a massive decline. Obviously because all these places closed, and they were open a little bit, then they closed again. So this this area got hit even harder. Parks and Experiences, obviously domestic fell 70%, international fell 60%. But consumer products, though, increased 2%. People are buying their Baby Yoda shirts. You know they are. Crazy. You hate to see that. I mean, incredible difference here in terms of operating loss. Massive, going from incredible profitability to incredible loss very quickly. Yeah, I mean, that's about what you might expect. Crazy stuff. I am going to go to this balance sheet, too, as we look at that. Worth looking at because obviously a rough year for them in terms of profitability. How has it damaged this balance sheet? They do only give me a 3-month comparison though, so that's one thing you got to consider. Total current assets right now sitting at $34.8 billion compared to $35.2 billion of 3 months ago. So about the same there, nothing too crazy. Overall total assets at $201.8 billion versus $201.5 billion. So again, nothing crazy changing there, all things considered. Now you see total current liabilities coming in at $26.5 billion compared to $26.6 billion. A slight decrease there. They shrank assets too. So nothing crazy in that aspect either. I mean, there's nothing crazy. I gotta be honest. In this 3 months, that's why I like you looking at a full year comparison, because this 3 months comparison, you see a stockholder equity is sitting at 88.7 compared to 88.2. So they did, manage to grow actually in terms of that in the last 3 months, which isn't a shocker because they posted a positive quarter. Now, obviously, things to mention. Balance sheet's in actually really good shape for everything they've been through. I can't lie to you. We're talking about a big balance sheet too, $201 billion on this balance sheet total. With $88 billion of that in equity, it's actually a really nice balance sheet given the circumstances. I do really appreciate that. Now, as far as valuation on the stock, one thing you got to consider, the stock's this is a long-term hold for many reasons. Market cap at $346 billion, and we're talking about an annualized revenue on this company. What did they do last year? Was it 70 billion? I think it was 70 billion last year. There's really only one way that a man might know this. It's by looking it up. I don't know why I had to Google that when I was already on the page, but so again, I mean, obviously trading at 350 based off of that revenue line is pretty nice. We want to be sure, obviously. Maybe we need to refresh because, oops, something went wrong, as it always does. In general, obviously, PE ratio has been wiped out on this company. There is a forward PE ratio in place right now because they're expecting some profitability lines, which is going to be nice for the following year. But I think overall, we're not looking too bad in terms of what they're offering, in terms of stock valuation. And again, I mentioned Disney Plus it's the way forward for this company, and even Hulu and ESPN Plus. Streaming is going to take over as the biggest segment of this company, no doubt about it. I mean, there's no doubt about it. It did on the full year last year. It did on this quarter. And the great thing is, once parks and recreation, once that segment opens up again, I don't even know where you start from there. Once it opens up again, you're talking about an extra, nearly doubling the revenue that they're doing right now. That'd be really crazy to see. Trailing 12 month of $65 billion. So, yeah, $65 billion. Market cap is not that expensive, all things considered. You're only talking about really 5 times that. So, I don't think the stock's ridiculously expensive. Nor is it ridiculously cheap, I guess you could say, but I think there's a lot of value in the stock over the long run. I still remember buying this thing, 3 years ago at $90, which I'd bought so much more. Just think about it. Again, this thing was stagnant for a while, but this stock's still a good buy. Come on now, guys.